What are stocks, really? Let me explain without the jargon. Imagine you want to start a business, but you need money. You do not have it. So instead of robbing a bank, which usually fails, you ask investors for money. In exchange, they get a small piece of your business. That piece is called a stock. When someone buys stock in your company, they become partial owners. Simple. Now, with this new money, you must resist the urge to buy a Lamborghini. Instead, you invest in growing the business. More growth means more profit, and investors get a cut of that profit. These cuts are called dividends. Everyone wins when the business succeeds. Now, people use stocks and shares interchangeably, but they're actually different. Think of it this way. Stock is ownership in a company. Shares are the units of that ownership. If stock is the entire apple tree, shares are the individual apples. The more stock you buy, the more shares you own, the bigger your percentage of the company. Not all stocks are the same. Blue chip stocks are from big, established companies. Think Apple, Microsoft, Johnson & Johnson. They grow slowly but are reliable. Penny stocks are from small startups or struggling companies. High risk, high reward. You could double your money or lose it all. Most beginners should stick with blue chips or funds. The stock market is where all this happens. It is where companies list their stocks and investors buy and sell them. When stock prices go up overall, we call this a bull market. Everyone is happy. When prices go down, we call it a bear market. Everyone is worried. Why these names? Bulls attack upward with their horns, bears swipe downward with their paws. That's it. Now, picking individual stocks is risky, so most smart investors buy funds instead. A fund is a basket of stocks. The most famous is the S&P 500. It contains the 500 largest companies in the United States. Tech, healthcare, finance, retail, all in one package. When you buy one share of an S&P 500 fund, you own a tiny piece of all 500 companies. Low risk, steady growth. This is what Warren Buffett recommends for most people. Hedge funds are different. They are high risk, high reward, and usually only for wealthy investors, not for beginners. So why do stock prices change? Simple. Supply and demand. More people want to buy a stock, price goes up. More people want to sell, price goes down. But what drives demand? Company is growing fast, price goes up. Company announces big profits, price goes up. Company loses customers, price goes down. Bad news or scandal, price goes down. Sometimes prices change for no obvious reason. That's the market being emotional. So here's what you learned. Stocks equal ownership in a company. Shares are the units you buy. Blue chips are safe. Penny stocks are risky. Bull market equals up. Bear market equals down. Funds like S&P 500 are the smart choice for beginners. Prices change based on supply, demand, and news. Subscribe for more finance without the fluff. I'm JustSo, and that's Just So.